welcome back to Young Money Hackers. If you ever wonder whether you should be going for houses or units or apartments and you go, I don't know what to buy, what's a better option for me, you are at the right place. And of course, we are Young Money Hackers. You're joined by myself, Handel, Kim, and Charlie. We discuss everything that is Australian property and investment for the young blokes and lasses out there. Thanks for tuning in today. How you going today, Chaz? What's going on?
I'm good, man. I'm good. This is going to be a good discussion. I think there are so many factors to consider for people, whether they want to get into an investment or just wanting to learn how to buy in general. This is a very popular topic in the property space, like apartments versus houses. A lot of people are attracted to them for either reason. So we're going to do a back-to-back comparison and do some numbers and actually like break this down for people, go through some of the pros and cons.
Exactly right. So we're going to be looking at three major questions and a breakdown at the end. So the three questions are, number one, what's cheaper? Number two, what's going to make me more money in terms of cash flow? And number three, what's going to make me more money in terms of capital gains? And then lastly, the pros and cons of each. So let's jump right into it.
Awesome.
What is cheaper?
Well, I've got an article here that shows the median house prices of the Australian combined capital cities, and it's currently, this is for 2023. And currently, the median house price for Australia's capital cities is $859,000, whereas units is only $617,000. So that, on average, does show that it can be easier for people to get into an apartment, but that's part of the story. So on average, units are cheaper across the board.
That's right. And bringing stuff home, we're looking at Perth, the greater region, WA, and we're looking at the median price for homes sitting at houses for $855,000, and then the units at a whopping $420,000. So almost half the price, it seems.
A lot cheaper. That is for the greater region of Perth. Exactly. It's so much cheaper, in Perth, the greater region. And also the yields of that same area. For houses, it's only 3.8%, whereas units, it's sitting at 6.4%, which highlights a massive difference in terms of rental performance, comparing homes to units. It's a massive difference. So
Exactly.
Yeah, and also the growth has been different for both of these two. So last 12 months in Perth, homes median up 3.3% in the last 12 months, down 5% for units. And again, a 12-month snapshot doesn't paint the full picture, but it's interesting to see that there's a major difference with appreciation and capital growth when we compare units to houses.
Fantastic. And I think we've sort of flown through, question number 2 and 3, but yeah, obviously addressing and segueing over to question number 2, which is which property type gives us more money by way of cash flow. That's right. So, the answer is right on the units actually generating more income per year by way of rental. We looked at this wonderful chart, I think, in the previous episode, looking at rental yields, the highest rental yields across Australia. And in many of these states, we can see that the units are actually beating the rental yields of houses. Okay, so we're looking at Canberra is around 6% average to 4% average comparisons. We're looking at New South Wales. We're looking at mid to high 4% average to mid threes average in Sydney. We're also looking at in Queensland. We're looking at in the units around the high 7s and the low 8s, so 8% average to about the late 5s and low 6s average in terms of rental yields for Queensland. South Australia is an interesting one. Houses actually yield more in the highest rental yield brackets than the units do, or they're around about the same. We're looking at Victoria. We're looking at higher rental yields once again for the units and slightly lower for the houses. Houses sitting at 4% and the units sitting at the high 4%. And then we've got in Perth, you're right, the overall, this is the highest rental yield bracket, that is. We're looking at all the units that are clocking it at the high 7s, low 8s to the high 6s for the houses. And we're looking at NT and also Tas, where the results are quite consistent as well. So yeah, in terms of looking at the rental yields for units versus houses, I think units are winning on the face value. But I think there's more than what it meets the eye. So we'll continue the discussion. Let's jump on to the capital growth. So what's happening across the nation on capital growth? We've had a look at that data, but looking at over the last 30 years as well.
So if we look at the comparison of growth over the last 30 years, when we compare houses to units, as we can see on this chart here, we've got it up. $200,000 is the starting point. And over this 30-year period, units are currently sitting at $636,000. Houses with land are currently at $928,000. So that is a pretty big difference. Over time, we can see that houses with land have appreciated a fair bit more than the units have.
That's a really interesting observation, and that's where we see Perth, for example, having gone through that historical growth of properties, is showing the massive discrepancy between houses and units there. So having combined all of this information, we want to discuss why this is happening, and for who some of these investments can be good and some of these investments can be bad. So we're going to talk about different pros and cons. So let's start with houses. So what are some of the things that make houses great, and what are some of the things that make houses not such a great investment at the same time, depending on the situation you might be. So what are some of the things that come to your mind right now, Charlie?
Okay, so some of the things that immediately come to mind is that...
Hold up, young money hackers. We got some exciting news to share with you, because it's all well and good to hear what's going on, but we'd hate to see our young money hackers only listen and take no action. So we've been working on some game-changing tools that we wish we had before buying our first investment property.
Exactly right, man. And it all starts with numbers. Property investing can feel like an extremely overwhelming process because it's the biggest financial decision that most people will ever make. So we have developed a property investing calculator that will make this whole process effortlessly. And seriously, man, I'm actually so blown away at how easy they are to use. All you need to do is put in your numbers and the info will tell you if that property is worth it or not. I'm actually so proud of them. Genuinely can't wait for our young money hackers to get their hands on this experience. But that's not all that's new here. We also have a mentorship experience.
And that's right, we want to share with you all the juicy details to see you through to that end goal where you're profitable on your property investments.
We also come across so many investment opportunities given the property space we play in, so it'd be rude not to share those with our young money hackers. So if you'd like to get your hands on some of the deals we are talking about on the podcast, we are offering acquisition services where we and our team will hunt down properties for you to push the button and get started to add to your property portfolio.
And what a dream it is, Charlie. And there's more. We're going to hook you up with top-notch property finance and insurance so we can all sleep at night.
But HD, what if I don't have the money to invest in any of these services right away? Is there anything for free?
Well, actually, we can help you with your finance and insurances for free. Plus, there are a ton of free resources we have for you, like some of the investment calculators, books, and tutorials available on our website.
Well, you heard him, everyone. So head over to our website, youngmoneyhackers.com, or simply click the link in the description. Check out our investment calculators, learn more about our mentorship program, and explore our acquisition services. At the very least, don't miss out on the free resources we've put together to help you guys get started. Now back to the podcast. Houses, firstly, there's no body corp or strata levies that you have to pay. I mean, some people are paying more than they realize in the beginning with strata fees. I mean, some of my friends are paying over $1,000 a quarter, which is $5,000 a year, which is $100 a week, and that is on the low end. So these things can be overlooked when going into a purchase like an apartment. So you don't get that with the houses. And also the development potential with houses is much greater. You know, you don't have to submit an application to do work on your house. It's your asset. You can do whatever you want with it. You can renovate it. You can subdivide it. There's more control over the actual asset itself. And that will give you potential for more growth over the long term.
Yeah, that's right. And of course, with units, when you're trying to buy like an apartment or something like that, there are a lot of units and apartments out there that don't actually have any access to land whatsoever. At the end of the day, we're trying to crack into an asset class that is a scarce resource, and land is a scarce resource, but bricks and mortar is not. And those things depreciate over time, whereas land will appreciate over time. So I think it's worth considering which kind of properties you want to be investing into. More importantly, though, is the point of entry. It is, yes, houses are more expensive, and yes, units are less expensive. But I think in this line of thinking, depending on the lifestyle that you're going for or the type of investment choices that you want to make, you really need to answer those questions up front. Are you buying this for investment, for cash flow, for a subdivision potential down the track? And no, you cannot have everything. You cannot have the best of both worlds. In some cases, you can, because you put all the work in and you find the right property. And that's, of course, something that Young Money Hackers team can help you guys out with. But you need to, if you're going to be doing this yourself, you need to be very vigilant about the information that you collect and the objectives that you're setting before you actually buy into a big investment like this. So I think having considered all of these things, I think there are pros and cons of both investment classes as well. With units, however, there is a lot, there is greater rental yield. And some may argue, like, your friend's case, Charlie, is that the strata fees are too bloody high. Yeah, that's true. And a lot of the rentals that you're collecting on extra, as compared to what you would collect on a house would be more, but you are actually copying a lot more on strata fees, which is then borne out of the landlord's pocket. Now, having said that, that doesn't also mean you have to go for properties that have high strata fees. You need to be checking these things before you then decide to buy a unit, if that's what you're going for. And of course, with houses as well, we're talking about development potential down the track. You could totally be buying a house that has no development potential down the track. You could be buying a house with, some skewed shaped land, or, even though it could give you good capital gains in the future, it may not come with those extra benefits. So you need to be checking with the actual council regulations as to whether the development potential actually sits with a house investment that you are actually making. And I think with units as well, some of the configuration on units, there are options for you to break away as well. And so it really comes down to case by case. But I think being really astute about all of this, not only just looking at the average data, but trying to find that not so average property where it can actually be more beneficial for you. I think that is the key to property investing.
Exactly. It is case by case. I totally agree. It's like you can have a house that won't perform well, and you can have an apartment that may perform quite well. But it depends it depends what you have in mind. It depends what your plan is. Do you have a strategy there that is going to set you up for the long term, which is what we really want to go for? The long term growth is what
Exactly right. And a lot of the units, they tend to be in a better sort of lifestyle locations, especially if it's closer to the CBD as well. If you have a plan, for example, to do Airbnb, do short-term rentals, right? Then that could be a really good way to invest in a smaller amount of money as opposed to houses, right? Less money to fit out the place as well, and you're gonna clock some very high rental income with short-term rentals as well, which I think is a fantastic strategy that a lot of young people are jumping into because of the lower point of entry as well. What about for houses? Can you do some renovations in there? No, there are no bylaws to follow. It is your control. It is your territory, and you have far more control. So I think those are the benefits as well. Whatever the property is, I think the goal is for Young Money Hackers is that we need to find a way to hack out the best option, the highest and the best use out of a property. And that's something that we want to profess more so than give a definitive answer. Oh, you bought a house, that's terrible. The units are better. Oh, you bought a unit, that's terrible. Houses are better. We're not here to have a neener discussion, but really trying to drill down on what are the best strategies for you to move forward with the investment decisions that you've already made.
Exactly, because there's opportunity in every market at any given time. So we can give a generalization and say that houses are better, but again, if you have a strategy in place and you know what you're doing, or you have the right guidance, you can find an opportunity anywhere.
That's right. So let's talk about some stories. What about let's share some stories. Where have you seen, a story of somebody who bought a house and has done well because they've done this? Where have you seen a story that somebody bought an apartment or a unit and they've done this and they've done really well? Let's share some of those stories.
Okay. So I think that what comes to mind right now is a story. My dad actually purchased a property in Perth for about $305,000. I think it was $305K. And a granny flat at the back, which costs under $70,000, it doubled the cash on cash return. And since purchasing 3 years ago, he's also experienced capital growth. Also due to the fact that he knows how to renovate well. So, you put in $1, you get out $2. that's one example of how to not only boost your yield, your cash return, so that's profit in the pocket every single month, but also to get that capital growth. So that is just a prime real life example of when it can. And also another little story is an apartment that I actually owned. I sold it about 4 years ago now, that underperformed. It didn't perform well. So that was before I knew better. And I did some work to it. I broke even, which isn't a bad result. It was a good learning opportunity though. So it just shows that like anything can happen in any market, but with the right strategy, you can do well.
That granite flat strategy is really impressive. I mean, the pain point that we are addressing with houses is that their returns are nowhere near as great as your units, right? We've well established that through our conversation today. And to think of a strategy like that, where you're adding extra livable space to gain further income, I think that's a fantastic strategy. And you're maintaining that capital growth as well as the cash flow. You're basically getting the best of both worlds. And this is the kind of young money hacking that we want to see from our listeners, and that's the kind of life we're living right now, which is great. I have seen people who, for example, because houses are really expensive to buy, so what they're doing is they're going to sort of beachside sort of destination, hour and 2 hours out of the city, and a lot of people do like the weekend trips out into these beach towns, and they get an Airbnb for the weekend. And they put a short-term rental in these houses, right? So it boosts their rental income like crazy. And plus it's got all that land, and it's a lower point of entry because it's a little bit further away from the city, but that income is there. So it's probably the same amount of money that these people could have spent on a very luxury apartment in the city. But instead of that, they've invested into a property with a good chunk of land in a growing area, growing sort of that, weekend destination area. Every city has one of those, it's somewhere near the beach, a little bit out of town, 40 minutes, an hour, 2 hours away from town. And they were able to boost their income that way as well. Similarly, people who own, like I said before, who own units and apartments in the CBD are actually gaining some double-digit gross yields on apartments doing Airbnb. And these are very, very simple strategies that you can implement once you do have access to properties like this. And the numbers are very much out there. And these are very reasonably typical results as well. A lot of short-term rentals are doing well with very, very low management as well. Because, think about it, you're not going to be getting like a 6-bedroom house in the middle of the city. You're getting like a 2-bedroom apartment. So they're going to be your corporate, people who want to stay in the city. They're going to be people coming into town just for a quick trip. They're not going to be any parties or crazy things happening in there or nothing. So so the owners of these Airbnbs don't actually have much headaches in managing all of these people either. So I think in every scenario, there are so many ways that you can benefit from actually finding out the highest and best use. And I bet you anything, in the case of your father who's actually put in the granny flat, I think that's a wonderful strategy, because I'm sure the bank would have gone through that property and probably done a valuation if he had triggered it. I don't know what he's done, but if he had triggered that, the bank would have done a revaluation where that would have increased the equity of the home so much that you could have done cash out refinance and be able to move to a subsequent investment as well, which I think is part of the excitement that we want to perpetuate by investing more and more into property.
Yeah, exactly. And the great thing about that particular case is that he didn't even have to subdivide it in order to do that. And I think that's a really creative way that you can go about it. So everything was approved, everything went through, but no need to even subdivide, which can be a headache in the whole process.
And whilst maintaining the option to subdivide down the track still. So the property still carries with itself the premium to be able to be subdivided, which would then get added onto a sale price if that was to happen later down the track, or be able to actually go down that track as well. But yeah, it's a fantastic strategy.
Totally agree. And it will add value to the property as well. Maybe not as much as if it was totally invested into the house, because it's seen as a cash flowing asset. It's not really seen as much part of the value of the property. So it does add value, which is a win, but the main benefit is for the cash flow.
Fantastic. And of course, the world of property is ever expanding. If you'd like to know more, guys, all the description and the helpful links are available below. Thank you so much for tuning into Young Money Hackers today. If you'd like further help, please reach out to us in the socials and the contacts available below, and we'll see you next time.